Well, certainly the market action has not been on the positive side, and I think the restoration hardware news this morning was very unsettling because investors are very concerned about earnings. It seems the market has discounted the Fed rates. We've seen PEs come in from 21.5 to 16.5 for the S&P 500. But now the big concern is, okay, we've seen signs of growth slowing everywhere, whether it's housing, retail, the commodity prices. The question is, how deep is it going to be? Are we heading into recession? Probabilities have gone up to over 50% in consensus numbers there. So it's now a concern with the restoration hardware coming out this morning and disappointing, cutting their numbers. People are saying, oh, my gosh, this is a sign of things to come over this next few weeks as we see many more company earnings reporting. So, that is, I think, the downside. The good side this morning was the PCE number. We are seeing signs, small as they are, that inflation is beginning to moderate. And that will probably take some time. We don't know. I don't think most people expect to see a big drop, but I think that is a positive. And I think there's a lot to talk about today in terms of this market action.
Yeah, Barbara, you mentioned RH. I've been calling it devastation hardware. Shares of the retailer are down after the company slashed its outlook for revenue, now expecting negative annual sales growth versus prior flat to up 2%. CEO Gary Friedman blaming slowing luxury home sales and the Fed's rate hikes. Not all doom and gloom for retail, though. In a new note today, Stifel said its latest survey shows the U.S. consumer remains resilient, but warning spending intentions for the lowest-end consumers and high gas prices hurting sentiment. Stifel saying Costco, Monster Beverage, Celsius Holdings are favorite retail names. Barbara, we were just talking about this earlier in the show. It seems like two different economies, even more than usual, for the poor, the lower middle class versus those that normally have a bit more money to spend. And yet, is there the risk of even those higher end consumers, at least, financially, reflected in these restoration hardware numbers, starting to feel a pinch?
Well, I think you're definitely right in the lower income. We know that most of the income on lower income, say under $75,000, goes toward food, housing, gas. And they're definitely going to feel the pinch with higher prices. Now, in the luxury, I think that restoration RH comment was about thinking that because you're seeing luxury housing down, the demand down 18% right now, that will spill over into them. It's going to be interesting to see. I mean, for them, you don't know how much was pulled forward because we know there's been so much demand, that was in the hard goods, which has now switched to services. So I think it's a little bit murkier with RH, but certainly. Yeah, we're not seeing, I don't think, as much hurt in the luxury end, although every stock holdings and bonds are down tremendously this year. So that's got to make people feel poorer, even at the high end.
Yeah. How wealthy do people feel? Often pretty important here, Barbara. Let's move on. Walgreens, one of the biggest drags on the Dow today, despite beating Wall Street's earnings estimates. But the company did report a larger than expected drop in operating income, partially because of fallen demand for COVID vaccines. Bertha Coombs joins us with that. Bertha, what are the other headwinds besides those vaccines?
Well, those vaccines, definitely a big one, but just the pharmacy itself. One of the things that they talked about is that they are trying to staff up again at their pharmacies so that they can reopen for more normal hours rather than truncated hours that a lot of these pharmacies have been operating under since the pandemic. And that is one of the things that they are focused on. But to do that, John, you've got to pay up. Walmart just said it was going to pay its pharmacists $20 an hour. So that's one of the headwinds that they have in terms of being able to staff up and have more volumes in the pharmacy, but also pay more.
Bertha, thanks. Barbara, it's a good thing that we don't necessarily have to fight the pandemic in the same way that we did a couple years ago. But this also speaks, doesn't it, to normalizing patterns and us not always being able to anticipate the economic effects when those normalize.
John, that is an excellent point, because I think one of the things, investors are so pessimistic, and it's hard not to be when you see day after day we have brief bear market rallies and then we're back to this. But I think people are forgetting the overall picture. We've just had a massive imbalance, caused by the shutdown in March. At least in this country. We've certainly seen it worldwide, where when we suddenly started to open up, we had flooded the system with liquidity, both monetarily and fiscally. This demand exploded. The supply chain was already disrupted. for various reasons in different countries with their lockdowns. And then you had demand overwhelming supply. So we're just, last year, things were priced to perfection. This year, things are more in balance, but it's still going to be choppy as we sort of get back to normal times. And I think we will. I mean, if you look at what's happening in the labor market, yes, you know, there's fewer job postings, but it's still 2 to 1. We're not seeing the layoffs we're hearing about are in the smaller, say, profitless companies that really need to pull in their horns. But you still got wage growth up, even though that's moderating, thank goodness, from the inflation end. And the consumer balance sheet, as are banks and corporations, the balance sheet is in great shape. And one of your guests earlier mentioned that $2 trillion savings number that is out there, you know, waiting to be spent. So, you know, the consumer demand, it's moderating. People are worried. You've seen consumer confidence numbers, but we are in good shape. And that's what the Fed is banking on. And I think they do have a little bit more room for error than you might normally.